Oh boy, what a start to the month. Japanese yields spiked yesterday after Bank of Japan's Ueda hinted at a rate hike in Japan later this month, sending equities and Bitcoin tumbling while gold and silver shot up. About 1 billion US dollar worth of leveraged crypto positions were wiped out yesterday, it is said. Today, things are happily calmer. The 10-year JGB auction went smoothly. In Japan, the US yields are steady as well and the dollar yen is recovering. But the US data shows cracks beyond the AI hype, while Black Friday and Cyber Monday sales this year rose, mostly due to inflation though. And Nvidia's 2 billion US dollar bet on Synopsys and OpenAI's Thrive Holdings play hands at a budding AI system or a house of cards. So we're asking, will today's fragile rebound hold, or are more shocks just around the corner? So we will talk about all that and more. So welcome to Swissquote's Daily Market Talk. It's December 2nd. I'm İpek Özkardeşkaya, and everything that I'm going to say to you in this video are my own opinions, and this is not financial advice. Oh wow, the month started very strongly with the Bank of Japan head Ueda throwing a hint yesterday that the Bank of Japan would deliver a rate hike when it meets this month, and boom, all hell broke loose. The Japanese yield spiked to fresh multi-decade high levels, pulling the other countries' sovereign yields up with them. Equities and Bitcoin tanked, gold and silver spiked. It was a disaster. It's said that $1 billion worth of leveraged crypto positions were wiped out at yesterday's sell-off. So it was bad. It was really, really bad. Today, the mood is much better after the 10-year JGB auction in Japan went quite smoothly and saw strong demand. You bet it did at the current levels of the yields, helping to stop the bloodbath in Japanese JGBs and other sovereigns as well. The US 10-year yield studies near the 4% mark this morning, and the dollar yen is recovering yesterday's heavy slump. Even though the Nikkei remains under pressure, Bitcoin and more technology-heavy pockets of the Asian markets have rebounded this morning. The Kospi, for example, in Korea is up by 1.61% at the time I'm talking here, while Bitcoin is also up, but it is up by less than 1% right now, which is very, very small in Bitcoin standards, because in fact, the coin has tested a very important technical support yesterday, which is the major 38.2% Fibonacci retracement just around $83,000 level. If broken, will send the coin straight into the medium-term bearish consolidation zone. What that means is that we could see deeper sell-off. But how deep? I don't know. It's said that the mining costs for Bitcoin are now around 70,000 US dollars. And because commodities don't trade below their production costs, that could be a floor for Bitcoin. But Bitcoin is not your typical commodity. You don't use it to build houses that you live in. You don't use it to build solar panels. You don't use it to build cars. You can't eat it. So that supply-only perspective somehow ignores the demand side of the equation for Bitcoin, which brings up the existential question of, when investors find out that Bitcoin could also fall in value, will the demand be as strong? Because if I'm honest, Bitcoin doesn't really have a material real-life impact or use case. We just buy it and wish it makes us rich, but we don't necessarily use it. Again, we won't be buying a pizza or a car with it. It mostly serves as a store of value right now. And the fact that there are a lot of funds parked in Bitcoin and now wiped out also means that there is less money for traditional investments. So if the sell-off in Bitcoin deepens, along with the rising Japanese yields and the risk of Japanese repatriating billions of US dollars back home, that means that we are still facing major risk to risk assets into the end of the year. So let's see if the Federal Reserve could just come back to charge and make people feel better about the markets, because yesterday's data out of the US was another cry from the US economy that the things are not going toward the right direction beyond the AI's golden dust, of course, because the factory activity shrank in the US for the 9th straight month. Orders printed the steepest fall in 4 months, and employment shrank as well. And judging by the looks of the latest economic data from the US and the activity on Fed funds futures, the Fed will almost certainly cut the interest rates when it meets next week. If it didn't, the market reaction would be just so sharp that no cut is not even an option anymore. So the hope is that the slowing US economy also slows down spending and tames inflationary pressures. The Black Friday sales reached a record high this year. Cyber Monday sales were also very robust according to the latest news, but a part of it was due to inflation, meaning that people in the US didn't necessarily buy more stuff, but paid more for what they bought. According to Salesforce data, Americans bought 1% less goods this Black Friday and paid 7% more for what they bought. And this will likely continue with the tariffs, right? Because someone has to pay. So the question is, who pays? So far, the companies have weathered the tariff cost by liquidating their pre-tariff stockpiles. Some others actually took the cost on their shoulders, thinking that this would be just temporary until the government sends gold and watches to the Oval Office, hoping to bring the tariffs lower. But the fact is, the tariffs are here and they should show up in inflation numbers unless the data is tweaked, obviously, but I'm not going toward that direction. Or US consumers start doing so badly that the lower demand neutralizes the tariff-led price hikes. In summary, it comes down to this. Does tariff-driven price pressure combined with softening jobs market in the US eventually force consumers to pull back? And if spending reverses, could that slowdown be enough to neutralize the inflationary hit from the tariffs themselves? I don't know the answer. What I know is that the US inflation cannot go higher than the actual 3% level without the Fed cut expectations fade. So we are in a very delicate place in terms of Fed policy outlook. A rate cut from the Fed next week may not even come as a relief if the inflation data doesn't look good, no matter how bad the rest of the data gets. But the US dollar remains under pressure right now below the 200-day moving average. The other currencies recover against a softer US dollar, but other traditional currencies like euro and sterling don't look appetizing either, given the exploding debt levels in these countries, budget issues, and bleak growth outlook. So gold, silver, and copper spike as investors around the world want hard commodities, and seemingly harder than Bitcoin to find a place to park in case of market turmoil. Of course, these metals are also an excellent hedge against inflation, which many argue Bitcoin is too, but Bitcoin is not around for long enough for an economist to say, yes, it's a good hedge. Sorry. Meanwhile, in the technology space, it's business as usual. Nvidia just started the week by announcing yesterday that it will invest $2 billion in a company called Synopsys. So this company makes the software and building blocks used to design computer chips. And incidentally, they also happen to be Nvidia's clients. OpenAI, on the other hand, is investing in a startup vehicle called Thrive Holdings, but they don't yet have enough revenue for themselves. So time will tell whether this handful of companies that are investing into each other is building an incredible AI ecosystem, or whether it all ends up being a house of cards. Happily, Nvidia was up 1.65% in yesterday's otherwise ugly session, meaning that investors have the incredible capacity to digest anything after an initial shock. Wars, exploding debt, tariffs, anything could be digested. So why not the AI deals? On a side note though, Bloomberg writes in a recent report that according to filings, and despite all the speculation around Nvidia has only just one guaranteed recent loan and 860 million exposure tied to a data center lease, with its partner placing $470 million in escrow and pre-selling the cloud capacity, which Nvidia says mitigates the risk. So that's cool, but the fact that a company with more than half the lease value in cash still can't borrow the remainder is obviously odd, and is exactly the kind of details that will become more obvious if something goes wrong. But for now, everything is okay. So this is all for this Tuesday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.